If you're a prediction market trader that is still not clear on the tax characterization that applies to your event contract activity, then this video is for you. I'm Patrick Camuso. I am the managing director of Camuso CPA. We're a CPA firm that works with digital asset investors, Web3 companies, and other traders, including prediction market traders. And, I've spoken a lot on this topic of event contracts and prediction markets. And the biggest takeaway is that the tax characterization of these contracts is still unsettled. There's not clear guidance. And it is something where we're seeing different taxpayers and different practitioners take divergent tax positions on the returns that were filed. And this not only impacts the potential tax rate that applies to a trader depending on the tax characterization they choose, but this also is going to impact how their losses, their losing contracts are deducted overall, and also how they're netted together between the winning contracts. So this characterization question has this other layer where it's not just a tax rate question. It's really a question of how are your losses going to be treated? And this is crucial for anyone that's trading these event contracts. So overall, losses are usually going to be recognized when the contract settles, expires, or it's abandoned. And again, the loss treatment is going to differ between the tax characterization of the contract. So at a high level, you can potentially, or different practitioners and taxpayers are treating these contracts as either ordinary, capital, gambling, or Section 1256. And these all have different treatments when it comes to the losses. So when you have capital treatment, gains and losses are netted against each other at the end of the year. If you have net capital losses, they'll offset your losses and your gains. Capital can fully offset. And then if you have net capital losses, that can go and offset your ordinary income only up to $3,000 per year. Then the excess will carry forward as a capital loss carry forward into future tax years. If you have other capital losses, you can apply those, or if you have other capital gains, you could apply those capital losses from the prediction markets to the other gains before applying up to the 3K limit to your ordinary income. So under capital, there's a benefit that you get full loss netting. And if you do have other assets, if you have the digital asset portfolio, if you have a traditional portfolio with a brokerage and there's gains in there, it could potentially offset that as well under this regime. Now, again, these are four different tax characterization methods, and this isn't something you can choose. You need to do a deep analysis around the type of contract you're investing in, the nature of your overall activity, to determine what the most reasonable tax characterization is, and then based off of that, these could potentially apply to you. So the another tax characterization that may apply is ordinary treatment. Under ordinary treatment, gains and losses are still netted together. You're not going to have the $3,000 cap against ordinary income like you would on capital.